Welcome to Charged Alpha's Q4 FY2026 earnings coverage. Today we're diving into Constellation Brands, ticker STZ. This is the company behind Corona, Modelo Especial, and Pacifico, and they just dropped an earnings beat that caught some analysts off guard.
That's right. EPS came in at $1.90 versus the street's expectation of $1.71. That's an 11% beat. Revenue hit $1.92 billion against estimates of $1.8 billion. And this all happened during a CEO transition, which makes it even more interesting.
We've got a lot to unpack here. A new CEO stepping in, the World Cup on the horizon, and a beer portfolio that just keeps winning. Let's get into it.
Absolutely. And with a CEO transition happening right at earnings time, there's a lot of moving pieces to unpack.
So for anyone not familiar, Constellation Brands was founded way back in 1945 and is headquartered in Rochester, New York. They've got about 10,600 employees and sit in the consumer defensive sector.
The crown jewel here is their exclusive U.S. import rights for Grupo Modelo brands. That means Corona Extra, Corona Premier, Modelo Especial, Modelo Negra, Pacifico, Victoria. All of those come through Constellation and only Constellation into the American market.
And that exclusivity is basically the moat. Modelo Especial is now the #1 beer brand in America by dollar sales. Corona is the #2 import, and Constellation has strung together 13 consecutive years of beer volume growth. No other major U.S. brewer can say that.
That 13-year volume growth streak is remarkable. Most domestic brewers have been treading water or declining, so to see consistent organic growth year after year really speaks to the power of these brands. What makes them interesting right now is the convergence of several catalysts. They've completed a major wine and spirits divestiture, selling off mainstream brands to the wine group for about $900 million. So the portfolio is now laser-focused on premium beer. Add in a CEO transition, conservative guidance that some analysts think leaves room for upside, and the 2026 FIFA World Cup, co-hosted by the United States, and you've got a company at a genuine inflection point.
Their remaining wine portfolio is all premium plus. Kim Crawford, The Prisoner, Robert Mondavi Winery, High West Whiskey. But make no mistake, this is a beer company now. Let's talk about the leadership transition because it's a big deal. William Newlands just stepped down on April 13th after 7 years as CEO. He was the first chief executive outside the Sands family, came with a Wharton undergrad and Harvard MBA, spent over 30 years in beverage alcohol, including stints running LVMH's Shandong division and serving as president of Beam.
Newlands was respected for the premiumization strategy and executing the wine divestiture, but his final years saw margin compression and macro headwinds that weighed on the stock. The new CEO is Nicholas Fink, who ran Fortune Brands Innovations since January 2020 and has been on Constellation's board for 5 years. His track record includes digital transformation and consistent outperformance during a tough operating environment.
So the board went with someone who already knows the company from the inside. The market seems to be reading this as continuity with a fresh operational focus.
It's worth noting that Fink comes from the building products world at Fortune Brands, not beverages. But his operational discipline and track record of navigating challenging macro environments could be exactly what STZ needs right now.
All right, Lana, let's dig into the financials. Where do we start?
Let's start with valuation. STZ is trading at $163.95, giving it a market cap of about $28.5 billion. The trailing PE is 16.86, price to sales is 3.12, and the EV/EBIT is 11.62. For a consumer staples company with this kind of brand portfolio, that's actually pretty reasonable.
How about the top line?
Trailing 12-month revenue is $9.14 billion. Q4 came in at $1.92 billion, which is down from Q1's $2.52 billion. But that seasonal pattern is normal for the beer business. Summer quarters are always stronger. Gross margin for the trailing 12 months is 51.7%. Operating margin is 31.3%, and net margin is 18.5%. Those are healthy numbers for the beverage industry.
And it's worth noting that the year-over-year revenue decline partly reflects the wine and spirits divestitures. On a beer-only basis, the picture looks much stronger. What about cash flow? That's been a strength.
It really has. Operating cash flow over the trailing 12 months was $2.67 billion, and free cash flow was $1.79 billion. That's a free cash flow yield of about 6.5%, which is quite attractive. In Q4 specifically, operating cash flow was $563 million, and free cash flow was $344 million after $219 million in capex.
A free cash flow yield of 6.5% on a consumer staples name is pretty attractive. That's real cash the company can use to pay down debt, buy back shares, or invest in growth. And the balance sheet.
This is where it gets more complicated. Cash on hand is just $102 million, quite thin. Total debt is $10.57 billion, with net debt of $10.47 billion. The debt-to-equity ratio is 1.31 and net debt to EBITDA is 3.2 times. Interest coverage is about 8 times, which is manageable, and the current ratio is 1.08, barely above water, but consistent for the industry.
So the debt is the elephant in the room.
It is, but they've been actively managing it. They used the wine divestiture proceeds to redeem senior notes and reduce the overall load. They returned $1.6 billion to shareholders in FY2026 through buybacks and dividends while still maintaining that free cash flow generation. Overall, Constellation Brands' financial health is solid. The cash flow engine is powerful enough to service the debt and reward shareholders simultaneously, but there's limited cushion if conditions deteriorate.
That health verdict makes sense. Strong cash generation offsetting a heavy balance sheet. Let's see what Wall Street thinks. So what's the consensus on the street?
The analyst community is mostly constructive. About 20 analysts covering the stock, roughly 12 have buy ratings, 6 are hold, and 2 are sell. The average price target is around $215, implying about 31% upside from current levels. The range runs from a low of $155 to a high of $280.
Any notable calls stand out?
TD Cowen just upgraded to buy on April 13th, calling STZ's FY2027 guidance quote overly conservative. They see the World Cup and Hispanic consumer stabilization as underappreciated catalysts. Evercore reiterated outperform with conviction on the beer volume growth trajectory. UBS maintained buy and highlighted Pacifico's 21% depletion growth as underappreciated. On the bear side, Bank of America kept their underperform rating, citing macro headwinds and the elevated debt load.
The most recent earnings on April 8th saw that 11% EPS beat and a 2% revenue beat. Management guided FY2027 EPS of $12.60 to $12.90 versus consensus around $13.10. So they're guiding below the street, which some view as sandbagging.
The pattern of beating then guiding conservatively is interesting. It suggests management would rather underpromise and overdeliver, which tends to build credibility with institutional investors over time.
Let me lay out the bull case here. First, the World Cup. The 2026 FIFA World Cup is being co-hosted by the United States, and for a company that sells Corona and Modelo, that is an absolutely massive brand activation opportunity. Management has explicitly said they're going to invest heavily against it.
On the bear side, macro consumer weakness is real. Consumer research still shows cautious spending patterns, and STZ's core Hispanic demographic has seen trip frequency and spend per trip decelerate. That's a headwind you can't ignore for a company this dependent on one consumer segment.
Second bull point, Pacifico. This brand posted 21% depletion growth in Q4, and management has a target to double its volume to 75 million cases by 2030. That's essentially an internal growth engine independent of broader category trends.
Counter to that, the aluminum tariff situation. A 50% U.S. tariff on aluminum imports creates about a $20 million margin headwind in FY2027, and 41% of STZ's products are packaged in cans. And then there's the bigger risk. The USMCA renegotiation in 2026 could theoretically threaten the duty-free status of Mexican beer imports. If that changes, it would be devastating for margins.
And the third bull point is the conservative guidance. When management guides below consensus, it often creates opportunities for upside surprises, and STZ has beaten estimates 4 straight quarters.
I'd also add that the wine divestiture clears the decks strategically. No more managing a declining business alongside a growing one. That focus is worth something. Fair. But that $10.5 billion debt balance means there's limited room for error. Net debt to EBITDA at 3.2 times isn't crisis territory, but it's not comfortable either, especially if interest rates stay elevated.
Let's see how STZ stacks up against its peers. We're looking at Brown-Forman, Molson Coors, and Boston Beer.
Brown-Forman, ticker BFB, is the Jack Daniel's parent. They traded a PE of about 30.5 with a price to sales of 5.2. Revenue is actually declining at negative 4%, so STZ looks significantly cheaper with better growth. Molson Coors, ticker TAP, is the value play in the group at a PE of 9.8 and price to sales of just 1.1. But they're also seeing declining volumes at negative 1.5% revenue growth. And Boston Beer, ticker SAM, sits at a PE of 22 with modest 2% growth. They're the craft and beyond beer innovator with Twisted Tea and Truly, but at a much smaller scale.
So STZ sits in an interesting middle ground, cheaper than the premium spirits names, but growing faster than the domestic brewers.
What stands out to me is that STZ has the growth profile of a premium company, but the valuation of a more mature business. If the World Cup and cost savings drive an earnings inflection, there could be meaningful multiple expansion.
What's the options market telling us?
The put-call ratio is 0.69, which tilts bullish. Of 8 unusual options trades detected recently, half were bullish and about a third were bearish. Call dollar volume of 342,000 significantly outpaced put volume of 148,000. The implied volatility percentile is around 55. Moderate uncertainty, but not extreme. Most of the interest clusters between the $90 and $145 strikes on the downside and $170 to $200 on the upside.
On the insider front, we don't have recent transaction data. That's not unusual given the CEO transition. There are typically blackout windows around leadership changes and earnings releases.
Worth noting that the company repurchased $100 million of its own stock in Q4, which is a form of corporate insider buying. And the board approved the new CEO appointment unanimously, which at least signals alignment at the top.
Good point on the buybacks. The company clearly has confidence in its own stock at these levels. Let's run through the key risks and watch points.
Number 1, the USMCA renegotiation. If the 2026 renegotiation changes duty-free status for Mexican beer, it fundamentally alters STZ's cost structure. Number 2, Hispanic consumer trends. Watch for any further deceleration in trip frequency data. Number 3, aluminum tariff impact realization through FY2027 margins. And number 4, execution risk during the CEO transition. New leadership always carries uncertainty, even from a board insider.
On the catalyst side, the key dates to watch are World Cup activation in the summer of 2026, Q1 FY2027 earnings to see if the conservative guidance starts to show upside, and any early signals from the Fink administration on strategic priorities.
I'd also watch the cost savings program closely. If they can hit that $200 million target ahead of schedule, it would provide a meaningful margin tailwind that the current guidance doesn't fully reflect.
So bring it all together, Lana. What's the bottom line?
Constellation Brands is a solid company at an interesting moment. The beer business is genuinely best in class. 13 years of consecutive volume growth, an unassailable Mexican beer portfolio, and Modelo as America's #1 beer brand. The Q4 beat, conservative FY 2027 guidance, and World Cup tailwind create a compelling near-term setup. The main watch items are the $10.5 billion debt load and the macro pressure on their core Hispanic consumer base. But with nearly $1.8 billion in free cash flow and disciplined capital allocation, they've got the financial firepower to navigate choppy waters. The metric to watch going forward is beer depletion growth. If it holds above mid-single digits through the World Cup, the bull case strengthens considerably.
Beer depletion growth. Got it. That's the single number that tells you whether the brand momentum is holding. Nicholas Fink, the new CEO, said this when he took the reins. I'm excited to join the Constellation Brands team and continue building on the company's strong track record of industry leadership. I look forward to getting out into the market and working with the team to further build on the company's core strengths, building great brands and leveraging innovation to satisfy more consumer occasions.
A measured opening statement. He's clearly positioning for continuity while leaving room to put his own stamp on the strategy. The emphasis on innovation and consumer occasions suggests we might see more beyond beer experimentation under his leadership.
That's going to do it for our Q4 FY2026 earnings deep dive on Charged Alpha. And hey, if you want to run the same research workflow we use to build these episodes, everything's free at chargedalpha.com. 11 screening tools across stocks, ETFs, options, crypto, bonds, REITs, commodities. No sign up, no paywall. The same data that powers this show is sitting there waiting for you to run your own screens. Check it out. Until then, I'm Hudson Thomas.
This podcast is for informational and educational purposes only. Nothing discussed today constitutes a buy, sell, or hold recommendation for any security mentioned. All investments carry risk, including the risk of total loss of principal. Past performance does not guarantee future results. Always do your own research and consult with a qualified financial advisor before making any investment decisions. The hosts and producers of Charged Alpha may hold positions in securities discussed on this show. This episode was researched, written, and produced using AI-assisted tools. All data has been aggregated from publicly available sources and may contain inaccuracies. Data is current as of the recording date and may have changed.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.